The global economy is like this massive, incredibly sensitive machine, right? You flip a switch in one hemisphere and suddenly alarm bells are ringing in another. Welcome to this explainer. Today, we're tracking a really complex global domino effect. We're connecting the dots from a tense naval blockade over in the Middle East all the way to Wall Street where folks are nervously waiting on big tech earnings. It is a wild journey from raw geopolitical power to artificial intelligence revenue, and honestly, the linkages are just absolutely incredible. So here are the 4 dominoes we're looking at today. 1. The Strait of Hormuz standoff. 2. Oil prices and inflation fears. 3. The Fed rate decision. And finally, 4. Big tech and global markets. Let's get right into it. Section 1. The Strait of Hormuz standoff. This is the geopolitical spark of our story.
Okay, let's dive into this with a number that is literally flashing red across trading terminals globally right now, $117.81. That is the peak price per barrel that international benchmark Brent crude hit for June delivery. And look, this isn't just some random blip for traders in suits. No, this directly trickles down to what you and I end up paying at the gas pump. It's actually the highest level we've seen since the fragile ceasefire between the US and Iran started. This striking figure is the direct, immediate result of news about a potential blockade, and it really sets the stage for everything else we're going to talk about today.
So, what exactly is driving that massive price spike? Well, it comes down to direct geopolitical action. Right now, a US naval blockade is putting serious pressure on Iran's economy. The US administration's stance has been laid out super clearly. On Wednesday, President Donald Trump issued a warning that Tehran should, quote, get smart soon and capitulate to Washington's demands for tight controls on its nuclear program. On top of that, during a meeting with oil executives, an administration official basically noted that the United States could extend this naval blockade of Iran for months to come.
But you know, in global geopolitics, an action almost always provokes a reaction, right? And analysts are raising a massive red flag about a potential countermove here. They're warning that an extended U.S. blockade would very likely prompt Iran to just maintain its own blockade of the Strait of Hormuz. Just for context, if you aren't familiar, the Strait of Hormuz is one of the most vital oil shipping routes on the entire planet. If Iran keeps up a blockade there, this absolutely critical global choke point is left at a near standstill. You're essentially bottling up a huge portion of the world's energy supply.
To really understand how the people moving global capital are interpreting all of this, just look at this quote from Arne Lohmann Rasmussen, the chief analyst at Global Risk Management. He points out that the market is increasingly shifting towards a view that, quote, no longer expects a quick and lasting peace nor an immediate reopening of the Strait of Hormuz. Wow. I mean, that is a stark realization. The financial and honestly the emotional weight of this narrative is heavy because the markets are kind of settling in for a grim long-term reality. Any hope for a quick resolution is just evaporating.
Moving on to Section 2. Oil prices and inflation fears. Let's talk about these commodity spikes. The literal second that blockade news hit and the reality of a long-term standoff really set in, the markets reacted explosively. Both main oil contracts jumped nearly 6%. That is a massive, sudden surge in energy costs. And guys, it might not even stop there. Kathleen Brooks, the research director over at trading platform XTB, issued a stark warning. She says this represents a new phase of the conflict, and that we could easily see Brent crude prices climb all the way back to those March highs of around $120 per barrel.
And this brilliantly illustrates the core economic antagonist of our story today, surging inflation. Look at what Anna McDonald, the investment strategy director at Hargreaves Lansdowne, points out here. She clearly states that the longer this conflict persists and the Strait of Hormuz remains disrupted, the more pronounced those inflationary pressures are likely to become. Because think about it, high oil prices don't just stay isolated in the energy sector, they bleed into everything: the cost of manufacturing, shipping, travel, everyday groceries. It basically acts like a tax on the entire global economy.
All right, Section 3, the Fed rate decision. We are waiting on inflation. So, there is a very clear cause and effect loop here that is putting the US Federal Reserve in a seriously tough spot. Let's walk through it. Step 1, the geopolitical standoff causes energy costs to soar globally. Step 2, those soaring energy costs cause inflationary pressures to escalate. Step 3, absolutely terrified of inflation, global markets start closely watching the Federal Reserve for any kind of guidance. Which brings us to Step 4. In the face of all this messy, complex data, the US Fed is widely expected to just keep interest rates unchanged later in the day. They're basically forced to hold steady while they wait and see just how bad the inflation gets. Meanwhile, kind of reacting to this tense environment, the US dollar has actually drifted a bit higher against its main peers.
So, if the Federal Reserve is basically playing the waiting game, holding rates steady to watch the inflation data, what exactly is Wall Street doing in the meantime? Like, where are investors placing their focus while the broader macroeconomy holds its breath? Let's find out.
This brings us to Section 4, Big Tech and Global Markets, the Wall Street Reaction. According to David Morrison, senior market analyst at Trade Nation, investors appear completely happy to just, quote, sit on their hands. And it makes sense, with talks to end the Middle East war at a total standstill, and that big Fed monetary policy announcement looming tonight, nobody wants to make a sudden move. Wall Street's main stock indices were mostly just sliding lower in late morning trade. The whole prevailing mood right now is just one of extreme caution.
So the crucial point is this fascinating contrast that is currently paralyzing the markets. On one side, you have these huge overarching macro anxieties, the geopolitical blockades and the Fed's interest rates. But on the other side, because investors are kind of sitting on their hands regarding the macro stuff, their attention has completely hyper-focused on the micro picture, specifically big tech earnings. Everyone is obsessively watching four of the Magnificent Seven: Amazon, Google, Meta, and Microsoft. These companies have announced enormous, mind-boggling capital expenditure to build out their artificial intelligence capabilities. Hargreaves Lansdown's McDonald actually notes that these results will be closely scrutinized to see if that massive AI spending is, actually translating into real revenue yet.
And the reason everyone is so incredibly nervous about AI revenue right now boils down to a very specific recent warning sign. Tech stocks already took quite a hit on Tuesday following a Wall Street Journal report that ChatGPT maker OpenAI actually missed its targets on user numbers and revenue. Think about that. If the literal poster child for the AI revolution is missing its revenue targets, Wall Street is obviously going to be incredibly hesitant about the billions and billions being spent by Amazon, Google, Meta, and Microsoft.
Because of all this, we're seeing a highly fractured global reaction to the uncertainty. Thanks to the oil blockade, inflation fears, and these tech anxieties, it was a broadly red day for stock markets in London, Paris, Frankfurt, and Wall Street. But interestingly, some companies are completely defying gravity through sheer performance. Look at this. Swiss banking giant UBS jumped more than 3% on a massive 80% rise in first-quarter net profit. German sportswear giant Adidas jumped more than 8% on strong profit growth. And finally, despite the weak lead from Wall Street, Asian stock markets mostly rose, with Hong Kong actually up more than 1%. It is a truly mixed, fractured global picture.
Which leaves us with this final overarching thought to wrap up our explainer today. We have two massive, opposing forces at play right now. On one hand, you have the heavy traditional gravity of geopolitical conflict and oil blockades threatening massive inflation. But on the other hand, you have the rapid, forward-looking engine of AI innovation and just unprecedented tech spending. So will the stark reality of the Strait of Hormuz or the future promise of Silicon Valley's revenue ultimately dictate the market's next big move? It's an incredible dynamic to watch unfold. I really hope this structural breakdown helped you grasp exactly how these global dominoes are falling. Thank you so much for learning with me today, and keep your eyes on the data.